In a market fueled by relentless momentum and strong fundamentals, Ryan Detrick reveals why even seasonally weak periods can't dampen the bullish narrative, posing the ultimate question: is a mild correction the very buying opportunity most investors will miss while they dwell on recession headlines?
Thanks for having me back. Appreciate it. So, first things first, late September, early October is a seasonal weak time. I know seasonals haven't really worked this year because we've been so bullish, but just big picture, when you think about it, we're looking at 5 straight up months, right? And when you're up these 5 months going into October, not too surprisingly, October is down on average. Okay, maybe you get a break. But here's what I think matters for the listeners. The fourth quarter is still up almost 6% on a median return, higher great majority of the time when you're up 5 months in a row going into it. So there's a lot more to it, Sully. But the reality, momentum's a powerful word, and we still think there's a lot of momentum to this bull market.
Yeah, but would you be happy with some kind of a pullback here, Ryan? Now, listen, I know it's painful. Stocks go down. We saw it in April. It stinks. It's like kind of gut-wrenching, but as somebody who's been doing this a long time, I get worried if stocks go up every day. It's just not, it makes me nervous.
I'm with you there. We'd love it. We would welcome, say, a 4 to 6% normal mild correction. Just a couple of things that do have our attention. Put to call ratios are some of the lowest levels we've seen all year. As I know you mentioned on your network a week ago, $58 billion to U.S. equity funds, like the most we've seen this year. So there is some optimism coming in with the Jewish holiday from now until early October. Maybe we get a little bit of volatility, a little bit of weakness. But again, it's going to be a buying opportunity, in our opinion, led by strong earnings, led by strong profit margins, led by, again, a stronger consumer. Look at those retail sales last week. We just don't see this recession. Some people talk about a recession still. We're just not seeing it. We'd still use it as a buying opportunity.
Yeah, what about corporate buybacks? I think there was a note out yesterday, record high. So not only is it, sort of individual investors putting their money to work, corporations are putting their own massive cash piles to work.
You're not kidding. Yeah, we've been seeing that a lot this year, obviously. And listen, go back in history and look. Yes, there's a point where if you buy too much, insiders buy too much, or corporations buy too much, maybe that's a peak. Maybe I'm looking at you 2021 with all those SPACs. But nonetheless, we've seen a lot of IPOs, seen a lot of buybacks. I mean, the reality, I think the answer to the question, the credit markets are still solid, right? I mean, even when we had the big pullback, the 10% pullback in early April in 2 days, credit markets are functioning just fine. So the reality, again, there's no monster under the bed. Corporations are still, there's a lot of deals. Every day you come in, there's like another AI deal out there. Deals are happening. Those are all still net positive to us.
Yeah, what's a worry for you then, Ryan? Mm-hmm. What would be?
Yeah, like I kind of mentioned a second ago.
You're paid big bucks, I hope, my friend, to worry.
Yeah, we do worry about some things. Like we just talked about, there is some complacency coming in there. There is a lot of optimism in certain pockets. We're seeing that. Maybe we could be due for some type of correction. One quick one. Just last week, everyone knows, the market's up, made a bunch of new highs. Only 2 groups outperformed last week. It was technology, communication services, right? If you look under the surface, mid caps are lower. We're not seeing, in my opinion, right now solely the participation that you prefer to see. Maybe, again, just saying maybe we could be due for 2 to 3 weeks of some consolidation, well-deserved pullback. But bigger picture, I think the bigger worry we have is a lot of people still are worried. There's that headline in the Wall Street Journal. Now it's like 1929. That's what worries me. Too many people are listening to these scary headlines, and they've missed a lot of this rally. I don't want them to miss the rest of this rally.
Is there any part of you, Ryan, maybe you heard the top of the show, that worries about all the AI spend, and what if it can't happen because NVIDIA or anybody else realizes, well, we can't make the electricity, so we actually are going to spend a little bit less, because those headlines are what's driving those stocks, which are driving the market.
No, you're right. I mean, what is it? 34% of the market is technology now. So clearly that is a potential worry. But that's one thing we've said all year, Sully. When in doubt, diversify it out, right? Have a diversified portfolio. Don't just chase the shiny objects. And look around the globe. There's a lot of opportunity, unlike the last couple of years. So have a diversified portfolio. If tech pulls back for some of those potential concerns, you'll probably do okay. Just like in April, we had that big pullback. If you had a diversified portfolio around the globe, it really wasn't nearly as bad as it felt if you're a U.S. heavy, specifically tech heavy.